At AVP. I think it's a really good example of an institution that's already doing well, just deciding to do better and just working really hard at that. So congratulations on the development, but lots to do. You've set yourself some tough targets, and we know that our allies in Dutch civil society will be holding you to account on those targets. So that's a healthy thing. Right, let's move swiftly on to our next panel, which is going to be chaired by Nicolas Firzli, who has arrived in the nick of time, if not a little bit late. But there we go. You're very, very welcome. Come on up. And the rest of the panel, we're going to have a session with the challenging title, Are Investors Doing Enough to Shift the System Towards Responsible Long-Term Investment? And while they're just taking their seats, I'd like to remind people who are using Twitter to use the hashtag ERIN2016. And maybe to @ShareActionUK. And if you're not using Twitter, then get out your phones and have a think about doing that. Okay, great. Over to you, Nick.
So the next session will tackle the following issue. Are investors doing enough to shift?
Please use your microphone, please.
Good. So the next session is, are investors doing enough to steer these millions and trillions towards responsible long-term investments? And I have here to my left Valeria Piani, who is the Associate Director for ESG Engagement at UNPRI. Then Anthony Hobley, CEO of Carbon Tracker Initiative. On his left, Timo Busch, Professor of Sustainability and Management at Hamburg University. And last but not least, Matthias Kopp, Head of Low Carbon Business and Finance Sector at WWF for Germany. And we thought we would start, each and every one of us, with a very short 3-minute max. I'm aware that we're constrained by time. Opening arguments, I guess. And so I will, since I'm holding the microphone, I shall start first. So basically, we're a Paris-based international association of institutional asset owners. That's mostly public and private pension funds, plus a few national social security funds and sovereign funds. And I've chosen 2 quick angles today. The first one, and I'm happy that that before us, we had a keynote address by Xander, who's a board member. Is he still around? Because board members and trustees are playing an increasingly important role because they are flexing their muscles more and more, which was not always the case in the past. Now, trusteeship itself is based on a French medieval concept, but we don't have it anymore in modern French law. And the problem is most countries in mainland Europe, Latin America, Asia, they follow the French civil code, so they don't have the notion of trusteeship. These days, it's a typically Anglo-Saxon, Scandinavian, Dutch notion. What does it mean? That these trustees in the past were absentee landlords. The CIO of the pension fund, to a large extent, could do roughly a lot of things on the ESG front without being hindered or without being constrained by the board. That is changing. That is changing, and I've used a quote from Professor Igor Ansov from the mid-60s, who was trying to imagine what the world, what the CEO of the future would be. And I've just replaced the word manager by trustee. So he was saying, the trustee of the future will be much broader gauged than his present counterpart. There will be a trend in the 21st century towards a statesman trustee capable of dealing with problems on a combined economic, political, cultural level. That is very important. That was in the mid-60s, and most people, when they read the article, thought that Igor Ansov was an idiot, because back then, roughly 15 years before Reagan and Thatcher came to power, the ideas that gave us Reagan and Thatcher, the Milton Friedman laissez-faire, were rising in America, and the idea was to let CEOs of listed companies focus relentlessly on short-term profit-making every quarter, and anything else, social, environmental, governance, was a crime and was a distraction and was a Soviet, whatever, communist conspiracy against capitalism. So, of course, that has changed, and today, the ideas of Igor Antsov are much more, I guess, valid, and they are taking off today in the field of asset ownership. I'll move to the next slide. Just a few quick notions. Something happened, so I'll just pick, California, but other stuff happened in Denmark and France and Holland, but I'll pick California. So in September 2015, the legislators in the parliament, in the state legislature of California, they passed a law forcing two of the world's biggest pension funds, CalPERS and CalSTRS, to divest rapidly from all their coal holdings across the board. So that's literally billions of dollars sold in the next few weeks in November, December of 2015. Now, that didn't happen in a vacuum. And behind the scenes, the trustees of CalPERS and CalSTRS did lobbying with the state senators and congressmen to reach that outcome, that law in September 2015. What was very smart, they did lobbying across the aisle. So even if they are labor-nominated progressive trustees, they did not disrespect Republican senators or congressmen. And on the contrary, they figured out that there were some center-right conservative Republicans who cared about the environment, and they reached out actively to them. And that's beautiful because that allowed them to build up a consensus and have that law. Basically, Laurent Fabius and John Kerry did the opposite in Paris at COP21. They did not reach out to senators and congressmen in Washington, D.C. And it's one of the reasons why the COP21 is so shallow and there isn't much substance. Anyway, that's a fantastic outcome that we got 6 months ago in California. And it sounds, for us here in the room, I guess, it sounds something very normal and natural for a pension fund to do. But that's the result of more than 15 years of efforts and lobbying and advocacy by board members and trustees. And California is supposed to be a progressive, liberal state. And as an example, I chose a liberal, progressive, eco-friendly newspaper, the New York Times. 15 years earlier, in October 2002, the New York Times were making fun of the trustees of CalPERS and CalSTRS. How dare they, these idiots, for the bond part of the portfolio, how dare they ask the CIO, the Chief Investment Officer of CalPERS and CalSTRS, when he was buying Brazilian bonds or Mexican bond, when he was meeting the ministers from Latin America to ask them about human rights, for example, in Latin America, or how dare they ask the CEOs of Silicon Valley companies to invest in less polluting technologies. So it shows you that even the liberal press wasn't initially favorable to ESG because it viewed, 20 years after Igor Antsov or more, it viewed that as meddling with natural, efficient capitalism. So thank God, things are moving in the right direction. They're moving slowly. And there are some nations who have the will and the capacities to steer these billions towards greener assets and more socially responsible assets. And for example, England, Holland, Denmark, Sweden, and Finland are really the kind of countries that are moving in the right direction. To a lesser extent, France, because France has less money in its pension system, because it's mostly a pay-as-you-go system. And without further ado, I will hand the remote control to Valeria, who's Anthony. Or can you introduce yourself and then you'll...
Yeah. Good afternoon, everyone. I'm representing the PRI. I presume a lot of people in the room know about it. It's been mentioned before. We had a board member before. What I wanted to do today is just to share with you a little bit of our thinking about long-termism and what we've been seeing on data coming from the PRI signatories. They have to report back to us every year on how they implement the principles, and we can use that data to have a sense of how the industry is moving. But one of the first things that we found quite challenging is actually defining long-term. There's no one common definition. Some people would just look at long-termism in terms of their liability, like 30, 40 years, from a pension fund perspective. But if you look at the investment managers, they will instead think of the length of their mandate. So it could be 2 or 5 years, or it could be 10 years. So we kind of moved from trying to find or define long-termism and actually agree on what responsible investment is, which is in the end looking at the long-term value creation. So starting from that point, we focus on what different actors in the financial system can do to promote responsible investment and therefore long-term value creation. And I think what we agreed on in the end is actually the asset owners have the key role here. They move the industry, they can incentivize investment managers, they can send signals to their consultants, they can engage with policymakers, they can engage with brokers. So we did our work starting from the asset owner perspective, and we just published a report on how the asset owners can move this forward. One of the major messages from our end is that asset owners should start incorporating ESG expectations in their investment beliefs. If you start from there, then everything can follow. And therefore you can have a governance system in place, and then you can start including this in the mandates with investment managers. There are many barriers for asset owners to do that, and we are aware of it. They raise issues of cost, of skill gaps, of not having products availability in the industry, of not having enough advice from consultants. And strange enough, there's also still skepticism about, does it make sense? There's plenty of research, there's plenty of evidence, but asset owners still need to do their own homeworks to be convinced. And it didn't really surprise when I heard ABG saying that they had to do their homeworks, literature review, to understand it actually made sense. This is the kind of message that you're getting around. So people have to do their own analysis to understand that. Then we outlined a few steps that asset owners can take to start pretty much keeping the investment management accountable. And we divide them between selecting, appointing, and monitoring the investment managers. In terms of how they could select investment managers, asset owners could put more expectations in their mandates on voting, on engagement, on integration of ESG issues, but also on reporting. Something that we noticed that asset owners are starting including some level of expectations on the mandates, but then they don't really use it to monitor what investment managers are doing. So the next step will be to use the information to see how the investment managers are keeping their promises and what they're doing. And actually including ESG discussions in regular meetings. As much as you want to hear about financial returns, you also want to hear about the impact of ESG in these returns. Another thing that we've been doing also is looking at the corporate perspective, and we've been looking at this together with the UN Global Compact, which is one of our partner organizations. And we look at the impact of short-termism on companies themselves. Companies actually have pressure from the investors sometimes on returning quarterly financial earnings. And that could mean that they have to focus on financial engineering, mergers, acquisitions, and maybe not investing so much in the long term. So with the UNGC, we also we mapped out a few steps on how the companies can also be more proactive in finding an investor base that is actually more long-term oriented and starting shifting from the ones that are more short-term to the ones that are more long-term.
Thank you. Anthony?
Great, thank you. Want to go first in that order then? Yeah.
Okay, then I will continue. My name is Timo Busch. I work at University of Hamburg, and a lot of questions were raised for this session, and I brought a few slides answering some of the questions. And I would like to start with some good news, and would like to end with a not so bright picture. At least that's my own perception. Okay, let me present in those 4 minutes that I have a few results of recent research that we conducted. This was a study, probably the most comprehensive study looking at ESG and financial performance out there. So we had a look at overall 2,000 studies that have been conducted, academic studies, and what we did is, well, academics call it a second-order meta-analysis, doesn't matter here, but what we basically do is we try to generalize the findings, academic findings. And what you see on this picture here is, depending on the underlying method, could be vote count studies or traditional accounting and statistical studies, there's a little bit variation, but what we can see, roughly 50, respectively 60% of all studies come to the conclusion that there is actually a positive relation between sustainability, ESG, and financial performance. And only 6.9, respectively 8, say there is actually a negative finding. So if you say now what's the difference, so there are some studies with neutral outcomes, mixed outcomes, but nevertheless, I guess the key message is looking at more than 2,000 studies, we can say more than 90% of those studies report that there is not a negative relationship. And by the way, if you're interested in the study, the source is down here, or just send me an email. There's free download in the internet. Another study we recently did is we looked at carbon performance, and we heard a lot about CO2 already today. And again, I would say this is probably the most comprehensive study looking at CO2 emissions of firms and financial performance. So basically what we did is took 10 years, more than 4,000 firms, and constructed portfolios. So it's a very simple portfolio study. So we said, let's take the first quartile, that means the best performers, those with the best carbon intensity, and compare those with the worst performers, the fourth quartile, in terms of carbon intensity. And here you see the results. We do find alpha, that's what many investors are interested in. There is a major difference. And the main result is this line group difference, where you see what the difference in alpha actually is between those two portfolios. It's large. And we did the same not only for alpha, we did the same for market to book ratio. And again, here the positive news is apparently those firms with better carbon intensity have a much higher market to book ratio compared to the worst ones. So, why do I believe, I mean, this is all backwards looking, right? Why do I believe that forward looking, this will even become more important to be aware of CO2 emissions and how firms deal with that? This is now kind of an effort looking forward, trying to estimate the carbon exposure of, in this case, energy utilities. And we have done it with a couple of other sectors too, but I thought energy utilities is probably the most interesting. So what have we done? We took 10 years, averaged the profits. Again, took 10 years, averaged the scope 1 emissions of those firms. And then we said, let's assume a ton of CO2 would be 80 euro. So it wasn't us coming up or making up this number. That's actually an estimate by the German Environmental Agency for that should be the real cost for a ton of CO2 if it would be internalized. So then we say, let's have two scenarios. The energy utilities have to pay 100% of the costs themselves, or they can transfer roughly 50% of the costs. So that would be the red part. So, and the clear message here is, if we do this analysis and just simply looking by the two large German energy utilities, E.ON and RWE, the graph basically illustrates that there would be no more profits, on the average of those 10 years. Well, the graph basically says the additional euros the companies have to bear compared to 1,000 euros profit. So in everything above the red line means no more profits actually there. So I think this clearly demonstrates risk exposure, and that should be an important topic, of course, then for investors. Now, I thought I would like to end with a not so bright picture. And my conclusion is, although there's some good news, a lot is happening, and again have here a number, 21.4 trillion US dollars incorporating ESG information, that's what a survey said, roughly corresponds to 30% of all assets under management. Yes, that sounds brilliant, but looking at the reality, what is it that we can observe? Like global sustainability trends, we could call it. And I just picked few here. Ecological footprint, we're using 1.6 planets. The Earth's overshoot day is getting close to July. So it's a trend. We're not improving, it's getting worse. Every single year, we have a new peak in global CO2 emissions. If you look at the UN Millennium Goals that should have been achieved last year, just 2 were met, many not, right? So this just illustrates the real world is not getting more sustainable, while on financial markets, we see a lot of movement, which basically raises an important question. Why is there this disconnect? And I think we can debate about that later on. I just would like to hand over now to Matthias, because I think he nicely will tie in here with his talk.
Yeah, maybe I then go first because I don't have slides, and then you'll pick it up. Or? Yeah. Yeah. So my name is Matthias Kopp. I head sustainable finance in the German WF, and I'm part of our international finance practice. And I would want to pick it up from where Timo has just left it. Since I'm German, I stick to the rules. We were given a few questions to answer, so I selected 3 or 4 of them. And the first thing I want to start with is the title of the session, when it's called "Are Investors Doing Enough to Shift the System Towards Responsible Long-Term Investment?" To me, the latter part of the sentence isn't really important, because long-term needs to be a function of is this system on its way to be sustainable? If that requires short-term action, then it should be short-term. If it's long-term, it's long-term, but it's not per se long-term to me, just a bit of a prerogative, but that's one point. And the other thing I wanted to focus on with this title is the system. Obviously, when we look at climate, and let's stick to that with that for a second, it's energy production and fossil fuels, clearly. But if we do talk about below 2 degrees, almost 1.5 as a limit, not even a target to stay below, then this means it's our economy. It's not only energy production, it's not only mining, it's steel, cement, automotive, shipping, airlines, you have it, real estate, basically the system. And what we've been focusing on today, understandably so, but that is energy, and I think this is this begins to worry me, because this is where we do focus on. Again, rightly so, but we can't just limit it to that. The other thing that worries me is we have 5 years left, 10 years left, if we look at what the IPCC scenarios tell us, and there is not even a 1.5 scenario that is credible that we can talk about. So this is highly, highly urgent. It's not as if we have sort of multiple years of time and we have 1,000 errors or attempts we can go for and then learn trial and error wise that it hasn't really worked. So we need to step up this effort like really big time. The other thing I wanted to look at is, and again, it has been raised earlier by Stan in the morning, is picking up the issue of carbon footprinting. And I deliberately don't want to be picking on ABP, because I think they are doing probably one of the better jobs in this industry. But also coming back to one of the questions we were given, which was, are investors doing enough? If we look at carbon footprinting, and Stan said it, I can't say it better, it's a useless indicator. Because if we say we want to transform the system going forward, and we want to check whether the system is on its way, transforming-wise, towards a 2 degree, below 2 degree, 1.5 degree system, we need to check forward-looking-wise, what are companies doing? What is the capex plan of companies that we are investing in, that we provide capital to? What is the measures that they are undertaking to reduce emissions and to prepare themselves on the journey going forward? And carbon footprint just gives you a snapshot indication of, okay, there's lots of emissions potentially in a company, but it doesn't tell you anything about the strategy, the capex plans, etc. So I think carbon footprinting is really, really beginning to worry me, because it's taking sort of hold as the standard, and it just can't be that way, because it's totally misleading, or even in the worst of cases, it's useless. And one other thing I wanted to say is there's quite some interesting projects around, some that we are also involved in, where some indicators, some metrics are available. So it's not about research that needs to be done. There's stuff available that needs to be tested. So I think I would invite like every investor here or that's around to approach the issue more broadly rather than focusing on carbon footprint. One other question we were given to look at is to say, what happened since Paris? Has that changed the story or the scenery dramatically. I would say the run-up to Paris was very helpful because it created this dynamic and lots of investors actually did stuff. If you look at the commitments, the pledges that were made, most of them were portfolio decarbonization, Montreal Pledge, focusing on carbon footprint, most of them. So the point that I'd like to sort of make again and re-emphasize, and maybe picking up from Timo's last slide, we need to worry about the real impact in the real world because that's what matters. If we fool ourselves with saying we have nice portfolios and we have decarbonized them by shifting investments from one sector to another, we sold them, hey, my hands are washed, but I sold it to someone else. Nothing has changed in the real world. All of us are having a problem with climate change. The final question I was given was maybe spend a second on Energiewende and what's the German situation, and maybe I'll pick on it for a second, and you'll decide whether you want to do it in more detail. One question was, are investors doing enough when it comes to German Energiewende, and is there something even as a contradiction between decentralized energy and institutional investment? And I think, from my perspective, how at least the ramping up of renewables in Germany, what made that happen and what was so successful behind it was a feed-in scheme we had, and that was mainly targeted at individual small-scale investments by individuals. So this is just the wrong question from the past, because the feed-in scheme made it such a generous investment for every individual. Put a PV panel on your rooftop, and or the farmer built a windmill on its ground. Things will change, because I think yesterday Parliament passed the new form of feed-in tariff, which is about auctioning off licensing to build new facilities that are larger scale that would require financing. So I think now it's a new game where investors will need to maybe take another bit of a position or a role in. So it's going to be very interesting to see whether in future this is actually something for institutional investing. I think so far capital shortages was not a problem in Germany when it comes to Energiewende in the energy sector. When we do talk about transformation in steel, cement, engineering, automotive, where we have like the German industry, I would say we do have an issue with capital provision that goes towards those projects that are actually really structurally decarbonizing these industries. But that's probably a different discussion to have. I would leave it here, and then Anthony, hand it to you.
Good, thank you. When I looked at this question, I thought long and hard about it, and also the Carbon Tracker's role in this whole debate. And I think one of the key missions the Carbon Tracker has is to get the financial market, or is to align financial markets with climate risk. And one of the ways that we do that is to get financial markets, players, institutions within the markets to understand that this is a real financial risk. Now, we talk to a lot of pension funds, a lot of asset managers, a lot of financial institutions right across the piece. And I guess my personal, is very much a personal belief, is until they really understand this is a real financial risk that could detrimentally affect their investments, you're not going to get the scale of movement that is required. I was going to say quickly a few words about what Carbon Tracker is, because it always surprises me that the people don't fully understand who and what, I guess, the Carbon Tracker initiative is now. You know, we're a not-for-profit NGO. We're entirely philanthropically funded. I think what's interesting about us is we're all former financial market professionals. And the biggest team within Carbon Tracker is a team of 7 former investment bank analysts, ex-HSBC, Citibank, Deutsche, Barclays, etc. And that team, I'm convinced, I know, you could parachute that into Goldman Sachs or JP Morgan, and they're producing the same level of investment grade financial analysis. So we're not economists, we're not policy wonks, you know, we're not looking at assessing policy and regulation. You know, we're financial market guys in a strange philanthropically funded vehicle. Now, and I think that is important. Now, this is what we're most well known for. You know, our reports for 2011 and 2013, and these, if you look at the hits on the website and you look at the citation of terms like carbon bubble and burnable carbon, I mean, this is the most read reports, the most widely disseminated of all the stuff we do. And it's very, you know, it's top down, it's very macro, but it's important. I mean, clearly there is it's not just a marginal, there's a massive disconnect between the amount of carbon we can burn at an 80% probability of staying below 2 degrees and the amount of carbon that is locked up in all of those oil, gas and coal reserves and resources out to 2050. So it's not a marginal problem. But the question is, how do you stop that juggernaut that is the fossil fuel sector from digging all of that out of the ground? They don't even need to dig all of it out of the ground to sort of cause us, massive catastrophic climate change. They just need to dig, a material amount more than 900 and burn that. So it is a massive problem. And again, as you see there, there's a difference based on current uses between oil, gas and coal. So you could do a little bit by switching from coal to gas and so on, but that's not a long-term solution. And ultimately, we know we've got to get the energy sector to net zero emissions by 2050. And at current rates, it doesn't look good because, we're going to hit that 2 degrees budget, or the energy sector is going to hit their 2 degrees budget in the mid-2030s. And sadly and unfortunately, we're pretty much there on 1.5 degrees at an 80% probability. So, 2 degrees is all to play for. Now, but what we did after that is, we built up the team of investment grade analysts. We bought the industry data, and I think that's critical. We use the same data that the energy companies, same commercial data that the energy companies themselves use, and that the investment banks and financial institutions use, Rystad, Wood Mackenzie, Bloomberg, and so on. So we're, I guess you could say fighting fire with fire, if you like. But because we're philanthropically funded, when we do our analysis, we can think in many ways about what the big problems are and the big issues. A typical analytical team in an investment bank has to think, well, if I do this piece of research, what sort of trades or transactions are going to fall out of this? So they're thinking short term, immediately. Whereas we're thinking, what's the bigger picture? What are the structural issues? What are the things no one's thought about when we do our analysis? Over 2014 and 2015, we did a series of looks, deep dives into the oil industry, then the coal industry, then the gas industry, and we produced this idea of a carbon supply cost curve. Bottom up, looking at every single oil, gas and coal project in the world and seeing where they sat, both in terms of the cost of that project versus, barrel of oil, and the carbon intensity. And oil was the biggest shock. And I remember when we did the oil report back in May 2014, the oil price was $120. Our analysts, on our detailed demand analysis, they couldn't understand why it was at 120. We thought the long-term equilibrium should be around 70 to 80. I remember that the head of oil and gas from one of the big investment banks in London was at the event, came up to us and said, "What are you guys smoking? The days of sub-$100 oil are over forever." Well, there you go. But what was interesting in that analysis is we broke that curve of all the oil projects down into 3 sections. All the projects that were sanctioned and going ahead above $80 a barrel, and again, because we felt the long-term equilibrium was around 80, we still think it's probably around there, over the next 30 years with a lot of volatility. We really looked hard at all of those projects above 80. I mean, there were some tar sands and Arctic projects in there that would never make any money unless the oil price got to $200 a barrel. And we were like, how the hell are these companies getting away with it? How are their boards? How are their shareholders? How are their investors? Letting them do these projects that forget climate for a minute, they don't make financial sense. And they have a potential to destroy value in those companies and increase debt and put strain on their ability to pay dividend and so on. But the market seemed blind to that. That was interesting. We also, found that, in terms of the amount of oil we can burn in the 900 gigatons over the next 30 years, but it was all below $60 break-even price. Of course, 80% of that sits in Saudi Arabia and the UAE, which is interesting and maybe puts a different perspective on what the Saudis have been doing for the last few years. But what started to drop out of this is the real financial risk, projects that make neither climate nor financial sense. So this alignment between projects that, are not environmentally or climate sustainable, but neither are they financially sustainable. I think that's really important. Another key bit of work we did, because we feel there's a hell of a lot of groupthink going on, and business history tells you this is nothing new. You're going to mention things like Kodak and Blockbuster and the American Steam Locomotive Company. Again and again and again, incumbents, get so used to the world as it is in its steady state that when the disruptive change comes, even if there's a lot of analysis out there, even if people are telling them, they cannot see or they cannot believe that what has been the case in the case of the oil industry for 60 years is now changing. And a good indicator of this is all the energy demand scenarios that are done by the companies, by the IEA. And we really dug into those in our Lost in Transition report. And this is just one slide that illustrates that, these are the IEA reports, but the BP Energy Outlook reports and the Shell reports and Exxon reports, similar. Grossly underestimated the growth of solar. Same with wind. What was also interesting is a lot of the assumptions that underpin those models, we really feel that they are picked to justify the business model and their view of the future. So they take the highest projections of GDP growth, they take the highest projections of population growth, but yet the lowest projections for things like renewable energy growth and energy efficiency and climate regulation, which of course gives them the answer they want. Allows them to feel comfortable and believe the world's going to go on. So a key piece of work we're doing at the moment is working with a major academic institution to develop a much smarter energy demand scenario model that hopefully will disrupt thinking around this. And the other thing that we suspected for a while is there may be a very strong financial argument for taking these companies ex-growth. So taking them into effectively a 30-year wind down in line with the 2 degrees pathway. But it was for a while it was intuitive. It was a gut feeling based on a lot of the analysis we were doing. So we looked at this and in our sense and sensitivity report, we said, well, what happens financially to these companies if you put them, on a 200-degree pathway? And we sort of amalgamated, the large companies into one, just to look at it as a whole, as a sector. And we came to the conclusion that actually these companies could be worth more. So if they're put on a 2 degrees pathway, share value could be better, and actually there'll be less risk to value destruction, and critically, less risk to their ability to continue to pay the dividends that many pension funds and asset managers are hooked on. Now, I know we know that there is one major oil and gas company at the moment, and I think this is probably the same for all of them, that is borrowing $1.1 billion a month to service the dividend expectation. I don't know about you. I mean, I'm a lawyer by background. When I studied company law, I always understood that dividend was a distribution of profit, not your ability to borrow. But of course they want their cake and they want to eat it. They want to continue to pay that dividend their shareholders depend on, but they also want to continue to pour trillions into growing, into projects that make neither climate nor financial sense. And that's going to create a massive debt burden. It's a big bet. It's a big bet on the oil price returning to sort of, levels of 2+ years ago. And if that bet goes wrong, that could be very disastrous, for the sector, for those companies, and for many pension funds and that dividend that's critical to them. I think this is interesting. I'm going to finish on this. Are we seeing the long twilight of the big oil companies? Is there increasingly pressure and not just a climate, it's clearly a climate case, I mean that's a given, but is there a financial case for putting these companies into runoff, rather than investing in potentially stranded oil and gas projects or gambling on new technologies they do not fully understand? Would they not be better, supplying the oil and gas and some coal that we need within the 900 gigaton budget over the next 30 years as we transition, because we're not going to switch fossil fuels off overnight, and it's naive to sort of say that we are, but you have to differentiate between the projects that we're going to need within the 900 gigaton budget, the 2 degrees budget over the next 30 years, and the ones we do not need. And in our view, it's those projects that are currently being sanctioned that would suck in trillions of dollars that will become the stranded assets if they go ahead.
Thank you. Without playing the devil's advocate, I mean, I'll switch to Matthias, who was the most skeptical about carbon and then come back to you. You said, Matthias, that focusing on carbon can be misleading, presumably because it leads to a rear view mirror of things, or it makes people focus too much on oil and gas, or what was the reason?
I said focusing on carbon footprinting is misleading. I think what Anthony is nicely saying is that forward-looking indication as to what transition plans of company look like in a context where carbon becomes constrained or even is unburnable makes a ton of sense, or even billions of sense. So there is a question of the metric, if you want. And I think there's one nice metric where you can say, I have decarbonized my portfolio by measuring, in an equity case, the amount of emissions linked to the companies in my portfolio, and then I allocate a bit of chunk of that according to my share ownership, is useless. And this is sort of making the same point.
Right, and if you had to add another, beyond carbon, another indication, another thing that we could measure to see if these companies are moving in the right direction, what would it be then, in your opinion?
Yeah, I mean, as I said, you look at the capex plan of a company, what the investments are that they are. In most of the industries, it's a range of technologies, say between 5 to 10 or so. It's not like 50,000 options that you have available to them, which would allow them to structurally decarbonize. Yeah. And that is a complexity degree that you can handle. So it's your capex plan. To some degree, it is the actual carbon intensity of what you do. It's the say where your feedstock comes from and how carbon intensive that is. So it's a range of things, but it's not over complex.
And Anthony, the Financial Times quote that came at the end was aligned with what you said earlier about their interest, basically their financial, cynical material interest would be basically to produce less, be aligned with a 2-degree scenario, and then create more value. And I think both you and the FT made the implicit assumption that they would act collectively, like you said, as one entity. So there was no competition. So the assumption was that these 7 big companies had no incentive to compete against each other. Because one of the reasons why we're seeing these bad things happening is the fierce competition between them, right?
Yes, but if you're actually producing projects that don't make financial sense, that cost you, more, put your debt up, destroy your shareholder value, and costing more to produce than you can sell those products for, well then, you're not going to be competing very well with a company that's taken an X-growth pathway and is concentrating on its low-cost projects that, the cost of production is much less than what it can sell those products for. And of course, that company is not racking up huge amounts of debt and has got a stronger financial position. It's also important to say, our demand analysis, we take a very realistic view of the world. And when we talk about, climate risk, I think this is important. We use climate risk as shorthand for a perfect storm of factors. It is emerging clean technologies and the maturing of those technologies. It is the dramatic, almost exponential drops we're seeing in recent years and the costs of those alternative technologies. It's different ways of doing things, the Internet of Things, Uber, and all the efficiencies that will come from that. It's energy efficiency, and it's last but not least, climate policy. I mean, in many ways, we're coming to believe, and we don't assume some sort of mythical fairy tale carbon price. In fact, we're quite skeptical about that. So we look at the world as it is and as it's likely to be, not as we would like it to be. And we still see a massive amount of financial risk and what we call demand destruction for oil, gas and coal, even the pathway we're going. Clearly not enough, and we've got to steepen that to get to 2 degrees. But I think what's heartening from this actually is we can begin to make a very strong financial case for these companies and their portfolios moving on to that 2 degrees pathway.
Right. And I'm happy to see that there was there was a certain amount of agreement between us as to the idea that time's running out, right? And I think the most, I guess, forceful one on that front was Timo, who said that time was really, really running out. Does it mean that instead of waiting for board members, trustees, the public, civil society to put pressure on CEOs and CFOs, does it mean that we need more forceful, aggressive legislation, in your opinion, to accelerate things?
Well, it definitely would be helpful, but will we see it in the short-term future? Well, I do have my doubts, and we had Paris, so the agreement is there, the commitment is there, but what now individual nations do with it, let's see. So it would be helpful, but in terms of what we see with climate policies, I do have my doubts.
Matthias?
Yeah, maybe one additional comment to this. I think currently the window that we have with the FSB task force is actually very promising, I find, because they have a mandate towards end of year, and they need to address whatever findings they have to the FSB, to the Club of the Financial Market Regulators. It's never been there before. So it's actually at the right spot. Question is, do they then translate this into binding regulation, etc.? We see, and it's been talked about earlier, we see the Article 173 in the French law. This is already law, and some of the cross-European pension schemes might be subject to it. So I think what's the saying? The sign is on the wall in a way. The question there is whether the politicians themselves do have the guts to see it through, if that's the right way to say it. But it's been, in my view, particularly when looking at the financial sector, it's never been as promising as it is today.
Right. Hopefully. And then one more question for Timo. You mentioned that 30%, right, or a third of assets that are more or less ESG informed, right?
Yeah, well, that's what the statistics say.
Right, but does it include sovereign funds and supranational money? So does it include the EIB, the World Bank, IMF money, or is it only non-supranational pension funds, insurance companies?
Well, to my knowledge, yeah, that's the assets under management by institutional investors and so on and so forth.
Because maybe if we add supranational, that figure would rise a little bit, maybe. Not much, maybe like 5% or...
And just from the perspective of PRI, from the data that we collected, actually, if you just look at Europe, for example, if you look at specific asset classes, on listed equity and fixed income corporate, pretty much everyone in Europe is saying that they're doing something on responsible investment in these asset classes. Then the level of sophistication can change a lot, but at least they are starting doing something in these two asset classes. In the other ones, the percentage is a little bit lower. And what is interesting that usually you see less of that if it's an internally managed asset by an investment manager, rather than if it's something externally managed by an asset owner. So there are kind of different perspectives there. Just talking a little bit also about climate change, we look at the awareness from investors on the risk around climate change, also at European level. And the percentages there are also quite high compared to the global average. So around 60% of the signatories in Europe say that climate change is a risk. But then the level, again, of tools, activities they put in place can change a lot. And carbon footprinting is probably the most common way of starting doing something. And I understand there are limits to it. But people also say that it's a way of starting having a discussion, at least internally, at board level, or with your investment managers. Or sometimes you understand you're exposed to some sectors that are actually increasing a lot of your emissions, and you could just, sell a few of the stocks and be much less exposed. There are people doing more sophistication analysis, but I think the message is after COP21 is kind of no-brainer that you need to start thinking about that. The only weird situation that we notice in Europe is Spain, where only 25% of the asset owners are saying that it's actually climate change is a risk. All the other countries are saying it is fundamental.
Right, and you mentioned that you did a survey, or you talked to many people in the investment ecosystem, so the consultants, the trustees, the fund management companies, which have a different definition of the long term, because for them it's the duration of their mandate, right? And then the asset owners themselves, and then you spoke about the barriers and the hindrances. When you talked before COP21 to people from Asia or Latin America or Chinese sovereign funds or Indian pension funds, did anyone say, oh, it's unfair, you're imposing on us an undue burden because you guys in Northern Hemisphere nations are so developed because you did so much pollution in the past, and we are just starting to develop, and it's unfair for us to apply these strict metrics? Or where the asset owners in China, India, where they aligned with the Northern Hemisphere on ESG matters?
I have a lot to say. They have an opinion. They didn't sign to the PRI. We don't actually have signatories in these countries, so no. So we have to, of course, have a footprint in more emerging markets. What we are trying to do now after COP21 is creating opportunities for channeling more investments towards emerging markets and infrastructure, for example, green projects. We have the Green Infrastructure Coalition, that is something that was created during COP21, that it's an opportunity for emerging markets to provide information on potential projects. They have to have at least 100 million of sites, and they have to have at least 5 years length. And what PRI would be doing is providing a platform to investors to see these projects and potentially to finance them. I think we would all agree that the amount of money that we need to channel to actually being able to succeed in anything, if it's not just COP21, it's also the SDGs. It's enormous. We're talking about 22 trillions to be able to even just meet the SDGs. So I think one of the elements of this is asset allocation. The other one, of course, is dialogue and engagement. I think these two can go together.
Could I just comment on that? Again, I'll bring it back to the financial case. I mean, if it doesn't make financial sense, why are you going to do them? Why is a developing country going to do them? And in many ways, I think many of the developing countries who were better, going for the sort of one-trick pony bet on fossil fuels for their economic future, are probably regretting that at the moment in the low oil price environment. They are hurting, and it's in a way is demonstrating to them that is not a sensible strategy going forward. And we're already hearing, Saudi oil ministers talk about the end of oil and how they have to get off their oil addiction and diversify. And we're hearing that from many oil-producing countries starting to recognise, we may be in the final decades of oil. And again, why now would a developing country build a fixed-line telephone system when it can go straight to mobile, to voluntary? They just won't. So why would they just doggedly follow the path of developed countries in developing, as opposed to doing what, we've seen them do in a range of areas, leapfrog the old 20th century technology in preference for the cheaper 21st century technology. And in many places in the developing world now, clean technology is the most cost-effective and cheapest option.
We have some questions, I think, and we will come back to that. We have questions from the audience.
Thanks very much, Hugh Whelan from Responsible Investor Magazine. Very quick reflection on Timo's point there, just referring to the chart that you showed on the screen, asking where the disconnect was between what investors are supposed to be doing and the change in the financial system. I mean, my perspective is that most people know that figure that's given in that chart doesn't represent anywhere near the activity that investors might be doing. In fact, it bundles up a whole heap of different things to get a very high-level figure. But my question really is for Anthony. You used a couple of beautiful euphemisms, Anthony. Market blindness, I noted down, and I think the other one was effectively groupthink. But what's really going on here in the financial markets about climate change? Because I remember last year, and it stuck in my mind a lot, but I think it was Matthias from Morgan Stanley, oil and gas analyst. He came into your event, stood up, did a presentation and said, it's really interesting to hear what's going on in your world. Fascinating stuff. But he's one of the top oil and gas analysts out there, and you'll know that they're looking effectively at a Mexican standoff with the political system on climate change. What's actually really going on there around the economics?
Well, I always compare. I mean, I spent many years as a lawyer in corporate law firms, and 99% of financial market professionals, they do best when they know how the system works and it's in a sort of steady state, and they have their heads down and they churn, and they rarely look up, to see when the world's changing. And we know that from financial crisis. A little bit like them. What's that cartoon character? Is it Roadrunner? The one that runs off the edge of the cliff. Sorry, I'll give you more euphemisms. And then keeps running for a while before it realizes it's run out of cliff. And well, the world is changing, but in all human systems, quite often the majority of humans who are good at functioning when that system's in a steady state are not very good at seeing the signs and the changes, and actually quite often, because it impacts their comfort zone, they ignore or try and deny them because they want their nice, comfortable world to continue as it was. In many ways, Carbon Tracker's biggest challenge, we can do this great investment grade analysis that tells you that climate risk equals real financial risk, but it's getting it out there and socializing it and communicating it to the right people and really getting them to understand that this is happening. So it's a communication, dissemination, engagement issue for us. And one of the things we're talking to funders about at the moment, because we have this great investment grade team of analysts, what we don't have is a sort of typical sell side team to get that analysis out there. And that's kind of what we're about to build now, because that's critical. And obviously working through organizations like PRI and CIRRS and the investors group, institutional investors group on climate change and so on. But you've got to get it beyond the ESG SRI community, and that's our big challenge now, into the mainstream financial community. And one of the things that we're doing, which is why, bizarre, for a philanthropically funded NGO, we sponsored the FT Energy event last week in London, is increasingly we want to get out there and we want to get into those mainstream forums and get this analysis and message out there. I think that is now the biggest challenge. I think our analysis shows this is a real financial risk and has to start being factored in, but it's actually getting mainstream analysts out of their, and financial professionals and asset managers out of their comfort zone to look up from their desk, and their great efficiency at churning in the current system and making money, to understand that and start, changing their behavior accordingly.
I think one of the reasons why it's there's a disconnect, if you will, between that Morgan Stanley chap and your people doing their very long-term studies is that we're talking about. Right, okay. We're using different sets of assumptions that may be better than the one used by Goldman Sachs and Morgan Stanley. But the problem is that that poor guy at Morgan Stanley, he's focusing on listed securities. And that's why, to come back to what you said earlier, you said that they produce research using assumptions about long-term demand, blah, blah, blah. That is a kind of a circular, self-fulfilling prophecy. Part of that is due to the fact that when it's listed, you're forced mechanically by the sheer mechanism of financial markets to play these kind of games. And it's difficult, I guess, to break the consensus. And to come back to what Valeria said, it may be easier, maybe, for non-listed assets like infrastructure, private equity, venture capital, and there's a little bit of hope. We've seen recently some positive signs. I mean, I'm an advisory board member to a World Bank department called the World Bank Global Infrastructure Facility, which is a new branch of the World Bank that was set up recently to encourage long-term co-investment by Northern Hemisphere, pension fund, insurance companies with the IMF, the World Bank, and the EIB into emerging market green infrastructure or infrastructure using ESG information. The Japanese government and the ADB is also doing similar things together with Dutch and hopefully British pension funds co-investing in green, mid-sized green infrastructure assets in Asia. So things are moving in the right direction on that front, non-listed stuff. And I think we have time for one last question, maybe.
Someone who hasn't asked.
Yeah, for me? Okay. So actually, Hugh, I want to support your point, and I think there's a fundamental misunderstanding here. So I worked for many years as an equity analyst, and I can understand the question this guy has asked, because when he said you're living in a certain world, he means that, of course, you're making the assumption of the 2-degree scenario. And I mean, the disconnect with what Timo has shown is simply that people do not believe in this scenario. And you have actually, what you are facing is a multitude of possible scenarios. 2-degree is one of them. The question is how likely it is. And of course, if you need to make investment decisions today, you need to take into consideration that you have more than just one scenario. So it's not at all about that people, smart people like this guy, do not understand your reasoning. I mean, it's not that difficult, and you made it very easy to understand, which is good, and to make the case. And but the truth is, there is no certainty at all that we are going to a 2-degree scenario. Rather, it's the opposite. It's very unlikely.
We do a 2-degree scenario, but in our demand analysis, we don't assume that. We look at what's actually happening and what's likely to happen, and we still see a huge amount of financial risk and demand destruction. And again, I think probably because of the sheer success of our earlier work, you know, part of our communication problem is getting that across. And very few people go, you know, we do these great summary pieces of analysis, but underneath every piece of carbon tracker analysis, there are several, sometimes 2 or 3 pieces of very detailed financial analysis, and quite often there's a big demand piece in there, where we look at the world as it is, but maybe with a different perspective, because we're looking at the emerging clean technologies. We're looking at the cost of those. We're looking at things like, you know, electric vehicles, and yes, we take certain assumptions, but that's not, you know, necessarily based on, oh, someone's going to walk in and impose some kind of 2 degrees pathway. But what was interesting is when we looked at all of those risks and to demand, what we call demand destruction for oil, gas and coal, and then we said, well, if you put, you know, if these companies put themselves on, or their shareholders put them on this 2 degrees pathway, forget governments tell them to do. There's actually a positive financial case for that based on the way the world is at the moment, and emerging technologies and changes in practice and risks from, you know, the way we're just changing the way we do things through the internet and so on. So I'd emphasize that, you know, we don't actually just assume some kind of arbitrary 2 degrees pathway that some, I don't know, fairy godmother is going to come down and impose. We look at the world as it is.
And if I may, just a quick comment adding to that.
10 seconds, go ahead.
Assumptions always, of course, about the future. But if you look at RWE and Aeon and their share prices, they're down. So it's not all about the future. We can tell already today they have the wrong business model. It's not working. And I mean, it's just a matter of time, and we probably will just see the same with all companies.
And we'll finish the session on that slightly optimistic observation note. Thank you very much. Thank you. Thanks a lot.